What is liquidity and why it causes market crashes? Markets don't crash because prices fall. They crash because liquidity disappears. That might sound strange. After all, when you hear about a market crash, you hear that prices collapsed, stocks fell, crypto dropped, housing slowed. But falling prices are the result. Liquidity is the cause. In this video, we're going to explain what liquidity actually is, why it matters more than price, and how a simple shortage of buyers can turn a small problem into a full-scale financial crisis. Let's start simple. Imagine you own a toy. Normally, if you want to sell it, there are lots of kids willing to buy. You can sell it quickly at a fair price. That is liquidity. Liquidity simply means how easy it is to buy or sell something without changing its price too much. When there are lots of buyers and sellers, markets are liquid. When buyers disappear, liquidity dries up, and that's when crashes begin. Here's the contradiction. If everyone wants to sell during a panic, shouldn't someone always be willing to buy at a slightly lower price? In theory, yes. In reality, fear changes behavior. Let's look at a real example. During the 2008 financial crisis in the United States, major banks held mortgage-backed securities that were considered safe. At the peak, the U.S. housing market was worth over $25 trillion. But when housing prices began falling, uncertainty spread. Investors didn't know which securities were safe and which were toxic. Suddenly, buyers stopped showing up. It wasn't that prices were slightly too high. It was that nobody wanted to trade at all. Liquidity vanished. When that happens, sellers are forced to drop prices aggressively just to find any buyer. That causes prices to collapse even faster, which increases fear, which causes more selling. This feedback loop is what turns a slowdown into a crash. Now let's break the mechanism down step by step. First, markets depend on confidence. Buyers need to believe they can resell later. Second, markets depend on leverage. Many investors borrow money. If prices fall, lenders demand repayment. Third, forced selling begins. When investors must sell to cover losses, they don't wait for good prices. They sell immediately. Fourth, liquidity providers step back. Market makers and large institutions reduce risk when volatility rises. At that point, there are more sellers than buyers. Prices don't gently decline, they gap downward. This isn't unique to stocks. We saw similar patterns in crypto markets in 2022. When confidence in major platforms collapsed, liquidity evaporated. Billions of dollars in market value disappeared in weeks. Not because everyone calmly reassessed value, but because buyers vanished. Liquidity is like oxygen in a room. You don't notice it when it's there. But when it disappears, everything changes quickly. So what causes liquidity to dry up? Usually three things: fear, uncertainty, and forced selling. Fear makes buyers hesitate. Uncertainty makes institutions reduce risk. Forced selling floods the market with supply. Together, they overwhelm demand. This explains why markets can fall much faster than they rise. During calm periods, liquidity is abundant. Spreads are tight. Trades happen easily. But during stress, liquidity shrinks precisely when it is needed most. That's why central banks often intervene during crises. In 2008 and again in 2020, the U.S. Federal Reserve injected trillions of dollars into the financial system, not to push prices up directly, but to restore liquidity, to ensure buyers and sellers could transact. When liquidity returns, markets stabilize. Prices stop falling not because fear disappears instantly, but because trading becomes possible again. So the next time you hear that a market crashed because prices dropped, remember? Prices drop because liquidity disappears. Liquidity disappears because confidence breaks. And confidence breaks when uncertainty overwhelms buyers. Understanding liquidity helps you see crashes not as random chaos, but as mechanical chain reactions. Markets are systems. And when one part of the system stops functioning, the ability to trade smoothly, everything else begins to break. If you found this explanation useful, consider subscribing. This channel explores how economic, business, and investment systems work and why they behave the way they do.